Ladies and gentlemen, distinguished guests, good morning, Happy New Year. It's a great pleasure being here today, an honor. Thanks to SKAGEN for inviting me. I've been to this country and this city a few times before. Beautiful country, very civilized in a world that is in turmoil. And I'd like to provide you what is my outlook for the global economy this year, and of course, discuss what's going to happen with some of the geopolitical questions, oil prices, what's the outlook for macroeconomic policies, and of course, maybe some of the market implications. Now, in order to understand where the global economy is going, we have to think back what has happened for the last 3 years. If you go back to 2017, as you remember, that was a year of a synchronized global expansion. Expansion means when growth is positive and accelerating. All major regions of the world were growing faster, many of them above potential, and global growth was 3.8% that year. Then in 2018, there was the beginning of a more asynchronized expansion. US and China were still doing well, but Europe and Japan were starting to slow down. And that was also the beginning of worries about protectionism and trade tensions between United States and China. And global growth fell from 3.8 to 3.4. Last year, we had a year of a synchronized slowdown, the way the IMF defined it, because 90% of the world was actually slowing down. US, Europe, Japan, China, most emerging markets. And global growth was only 3%. So we went from 3.8 to 3.4 to 3%. Now, from a market point of view, of course, as you remember, last year was a great year. US equities up 30%, but that occurred under a background in which in the fourth quarter of the previous year, 2018, there was a massive risk-off episode driven by both Fed policy and global risk, and US and global equities went down almost 20%. So of the 30% of last year's return, 20% of it was just making up for the correction that occurred in the fourth quarter of 2018. So over the last 2 years, average return will be much lower. That's one point to keep in mind. So the question mark is, what's going to happen to growth, of course, this year? And here I'm presenting to you 4 potential scenarios. Scenario number 1 is the consensus, what Wall Street, folks like JP Morgan, Goldman Sachs, but also IMF is saying. They say there'll be a pickup of growth, moderate expansion. From 3%, we're going to go to 3.4. Not as strong as 2017, but beginning of some moderate expansion. Why? Some of the global tail risks, the risk of an escalation of a trade war between US and China, are on the side. The risk of a hard Brexit is on the side. And last year, as you know, Fed, ECB, and major other central banks around the world, advanced economies, emerging market, cut interest rates. So there's been a significant easing of financial conditions, lower short and long rates, lower credit spreads, US and global equities up. And that easing of financial conditions should lead to some pickup of global growth. Not exceptional, but at least we're going higher. Second view is one in which I have more of a view of it, is that there will be some factors going to lead to a continuation of the current economic slowdown, meaning growth this year, 3%, is not going to be any better than last year. Third scenario will be one in which we could have a further slowdown or a near stall of growth, what people call a growth recession, with global growth at 2.7. By the way, this is for the world, and as you know, the average growth for a typical emerging market is around 5%. The average growth for an advanced economy is, depending on the region, US potential of 2%, in Europe and Japan, at best, maybe 1%. And of course, there is a fourth scenario, one in which you could have a global recession. The IMF defines as a global recession one in which global growth is less than 2.5%, because in that scenario, growth in advanced economies will be 0 or negative, and if China were to say slow down from 6 to 3, or India and so on, of course, that's equivalent to a recession. So the question is, which one of these scenarios is going to be more likely? Because, of course, these scenarios have relevance for financial markets and what's going to happen to key asset prices. The first point I'll make is that even if we leave aside the current tensions between US and Iran, and I'm going to discuss them in some detail, my view had been at the beginning of the year, before that was the assassination of Soleimani and all the other tension, that scenario number 2 was more likely than scenario number 1. So the view that was slightly below consensus, not radically, but below consensus. And I would like first to argue why Actually, the idea there'll be an expansion of growth as opposed to continuation of this current slowdown was more likely even if there were no build-up tension between US and Iran. And of course, the build-up of tension between US and Iran may make things worse. Several reasons. Reason number one, if you look at the macroeconomic data for the US, Japan, Europe, China, many emerging markets, they are not worsening, that's the good news, but they're not significantly improving. If you look at the forward-looking economic activity indicator like ISM and PMI, they're still weak and fragile. People say, wait, maybe by the second half of this year, we're going to see the improvement, but the data are not yet suggesting that improvement. The good news, however, is that we are not having that further fall. And as you know, last year, we had a recession in manufacturing and industry, we had a recession in exports, and we had a recession in capital spending, because there was an option value of waiting. People didn't know whether the trade war between US and China would escalate. They wouldn't know whether it'll be a hard or a soft Brexit, and therefore, better wait and see. Option value of waiting, capital spending was down. What sustained that mediocre global growth last year was domestic demand rather than foreign demand, was consumption rather than investment, and was services rather than manufacturing. A second point I'll make is that while markets are now optimistic that today US and China are going to sign the phase one deal between US and China, in my view, the US-China Cold War and decoupling is going to continue this year. And it's not just this year, it's a medium-term phenomenon. And I'll give you just one anecdote. About 4 years ago, November of 2015, I was in Beijing as part of a small delegation. And we had the honor and pleasure of meeting Xi Jinping and the Great Hall of the People of Tiananmen Square. And we had a private audience for an hour and a half. Xi Jinping started his remarks, unprompted, for the first 10 minutes, citing the Thucydides trap. Now, many of you might know what the Thucydides trap is. For those who don't know, Thucydides was the great Greek historian who wrote the story of what happened when there was the rise of Athens, a new rising power, facing an existing power, Sparta, and then war occurred. And since then, the term Thucydides trap is being used to discuss geopolitical tension when you have a new power rising in the world facing an existing one. Now, this meeting occurred a year before Trump was elected. And of course, Xi Jinping wanted to make the argument that the rise of China would be peaceful, that there would not be the Thucydides trap. But a year later, Trump gets elected, November of 16. And 2 years later, Professor Graham Allison wrote that famous book titled Destined to War, ? Will US and China avoid the Thucydides trap? And as he pointed out in that book, in 12 out of 16 historical episodes, when you have a new rising power facing an existing one, eventually wars occur. And the last two examples were, of course, World War I with the rise of Germany facing the continental existing power, World War II again with Germany and Japan facing US and some continental power. Now, nobody today believes there will be a hot war between US and China, even if some strategists, both in Beijing and in Washington, are starting to think about even those extreme scenarios, but the likelihood of a Cold War between US and China has been rising. And it's the beginning of it, of course, is a trade war, but if you look at technology, information, data, investment, capital market, movement of labor and talent, monetary financing, currency issues, we are at the beginning of a Cold War between US and China. And that's important because for the last 40 years, the world has had a process of globalization integration. Since 79, when Deng Xiaoping opened up China, since 89, when there was the collapse of the Soviet Union and the Berlin Wall, and there was the integration of the former Soviet Union and Eastern Europe into the global economy, where more globalization, more trade in goods, in services, in capital, in labor, in technology, and information. But if this global rivalry between US and China will occur, we could be at the beginning of deglobalization, of a decoupling between US and China, of a balkanization of global supply chains, from technology to manufacturing to industry and so on, and a fragmentation of the global economy. And I'll give you only one example. Today, US fears, rightly or wrongly, that the 5G of Huawei may be having a backdoor to the Chinese government. It's pushing every ally to say, don't use it. But today, those 5G networks are just driving our smartphones. But tomorrow, those 5G networks are going to be driving a system of, say, autonomous vehicles. You need something to make sure that millions of cars that are autonomous don't hit each other. But tomorrow, pretty much every piece of consumer electronic, even a Chinese toaster or a coffee machine or a microwave or any kind of piece of consumer electronic might have a 5G chip. So if you're worried that there is a backdoor and the Chinese are listening, when you have a war on technology, then you have to restrict even trade. And that's the beginning of deglobalization and decoupling. And I'm not having the time today to see how there are restrictions to investment. Already, Chinese FDI has fallen 90% into the United States, restriction to portfolio, to movement of labor, of capital, and so on. But we may be at the beginning of decoupling and deglobalization, and that's going to be disruptive. It's like a negative supply shock that increases cost and reduces global growth. And that's going to happen already today, even with the phase one deal. Third problem, Brexit might not be hard, but it's going to be bumpy. I was just in London for 4 days, and there is a risk of a cliff at the end of 2020, because even Boris Johnson now say it'll be mission impossible to get a deal by the end of the year. It took 7 years for Europe and Canada, and if you don't have a deal and the Brits don't want to expand the transition period, then you could have hard Brexit occurring at the end of this year, as opposed to at the end of January this year. Additional point, the problems of Europe and the Eurozone go well beyond Brexit. You take the 4 major economies in the Eurozone, Germany, France, Italy, and Spain, they're politically fragile, and I don't have time to go into detail of it. Growth is slow, and it's not going to be any better this year than last year. Potential growth is low because a structural reform are occurring slower than desired and unoptimal. The monetary union is fragile and is not getting more integrated. There is not more risk sharing. And of course, some countries, if there was a recession in the Eurozone, like Italy, will have an unsustainable debt situation. So, or take the auto sector. It's not just emission standards, and it's not just the risk of trade tariff by the US against European cars, but also massive oversupply in the world and a fall in demand. So these are problems that are going to keep Europe and Eurozone in slow economic growth. Additionally, there are some serious problems in the United States. US politics this year is going to be extremely dysfunctional. You have the gridlock with the impeachment. Of course, he's not going to be convicted. You have the possibility that Democrats might nominate a progressive, and even starting with the primaries in February, if one of those progressive does well, the market may start to correct, because these progressive, whether Warren or Sanders, want to tax more capital, more profits, more corporates, more the wealthy, more the rich. Maybe that's fair, but the market's not going to be happy about that. And then the risk that the election is going to get really ugly. Either side is going to say the election was rigged. There may be constitutional things. People even worry about domestic violence. It'll be a very dirty and nasty electoral campaign, and that might be noise that might affect the market. In the US, there is another problem. We have the excesses of the late cycle. You have very high and rising corporate debt, whether it's CLO or leverage loans or fallen angels in the high grade, $500 billion of debt that may be downgraded from high grade to high yield because these firms are being downgraded, or whether it's the massive issuance, of course, of debt among the high yield, the junk bonds. And of course, the covenants are light and the credit conditions have been loosened, and that's a time bomb. Of course, in a late cycle, after 10 years of growth, potential is falling, actual growth is falling, that slows down profit growth, and even if you had a mild pickup of wages, acceleration at a time where the pricing power of the corporate sector is low because there is a lot of competition, that could squeeze profit margin. And one observation I'll make about the US stock market is that US equities are certainly frothy, if you don't want to use the term bubble. If you use the Shiller Cape, the cyclically adjusted PE ratio is at 30, 3 standard deviations above historical norm that suggests that eventually a correction is going to occur, but also a multi-year correction. Lastly, there's been a slowdown in the growth rate of earnings per share, and therefore the rise in valuation, that 30%, 90% of it has been driven not by stronger earnings per share, but rather by multiples, the P ratio becoming even higher, that are again at historical high. And therefore there is a strong risk of correction, especially if term premia or risk premia or credit premia might spike for one reason or another. Final point I'll make is many emerging markets are quite fragile or politically unstable. This year, I've seen riots even in stable countries like Colombia or Chile in Latin America, let alone Bolivia or Ecuador, or the troubles occurring in Mexico or in Venezuela. You have had riots all over the Middle East, from Syria to Iraq to Lebanon to other parts like Sudan or Egypt and so on. Even in Asia, political turmoil in Hong Kong or places like Indonesia, let alone the fact that some major emerging market economy look fragile. In my view, China this year is going to grow 5.8%, less than 6% of last year. I was just in India, where there is a sharp slowdown of growth from 7 towards 4. And as you know, there is trouble in Turkey. There is trouble in Russia, where potential growth is low. South Africa is fragile, to give you some example. So emerging markets are not tanking, but they're not doing that great. So if you list this point together, it suggests that actually the idea that we're going to have an expansion rather than continuation of a slowdown, in my view, there's plenty of headwinds that could give us scenario 2, growth of 3 rather than going to 3.4. That now leads me then to discuss the scenarios for the US-Iran conflict. There are essentially 4 potential scenarios. One is the return to the status quo after the short-term tension, and most of the press and the analysts and markets are now saying, you see, they try to attack or pretend to attack the US bases, but they announced it, so everybody took over, nobody got killed. The US said, I'm going to refrain myself, so we're going to go back to normal. Secondly, that you could have an escalation of the tension short of a directly military exchange between US and Iran. Iran could attack proxies, using proxies, could attack Israel, could attack facility of Saudi or other Sunni in the Gulf, and militias and so on, but not a direct attack against US. 3, you could have a direct military exchange between US and Iran, say naval warfare in the Gulf, but not a full-scale war. And of course, there is the worst-case scenario. This is one of a full-scale war. Now, the point I think is important that I'd like to make is a critical one, is the following one. You could agree that currently the risk of a full-scale war between US and Iran is low, because if there was full-scale war, Iran gets destroyed, and if there is full-scale war, all spikes, and then Trump loses the election because there'll be a global recession. But then the markets make the mistake, and they are underestimating the risk of a conflict because they say, if scenario 4 is unlikely, then the more likely scenario is we're going to go back to the status quo. And you saw it in the market. After the attack and the killing of Soleimani, all spiked. Global equities went down a few percentage points. Bond yields fell. There was risk off for about 3 days. And then after there was that minor attack and everybody restrained, everything went back to normal. And now US equities are close to their highs, and bond yields are back, and oil is back at 65. So the market believes that scenario 1 is the more likely. My point is that the other 2 scenarios of some degree of escalation or a direct military conflict are actually more likely, and those are the probability assigned to those scenarios. And once you go from stage 1 to stage 2, and from stage 2 to stage 3, even the risk of a full-scale war becomes more likely. So the point I want to make is the following one, that is also important. People say that Iran wants to avoid a full-scale war because there'll be a destruction of its own military and civilian infrastructure. However, the main objective of Iran, and I'm myself an Iranian Jew, so I know Iran because I've been there for quite a while, and I understand the country quite well, is the major objective of the regime in Iran is survival. They want to survive as a regime, and the survival of a regime depends more on avoiding an internal revolution, people in the streets getting rid of the regime, rather than a war that's going to lead to the collapse of the regime. Because even if there is a full-scale war, even if there is a bombing of the facility, short of US sending troops on the ground and invading Iran, and that's not going to happen, the regime is going to survive. It's going to survive because even if you destroy infrastructure, economically it'll be a disaster, but you survive. But more importantly, if there is a full-scale war, even those who are against the regime are going to rally to the regime because the rest of the world is attacking, like it happened after the killing of Soleimani. So even a full-scale war, the regime gets the support of the population, there's not an invasion, and the regime survives. And the objective of the regime is to survive. So paradoxically, in a case of a full-scale war, there is regime change not in Iran, but in the United States, because if there is a full-scale war, oil goes to 150, stock markets collapse, you have a global recession, and then Trump loses the election. So the idea that Iran wants to avoid at any cost a full-scale war is not fully warranted. They don't want it, but they want an escalation, and that escalation is going to have dramatic implications for markets and economy. So scenario one is unlikely, and the other ones are more likely. So what are the implications for oil prices of those four scenarios? Now, if the consensus is right, and we're going to have the status quo, of course, oil is going to be below 70 at current level. However, even in a mild escalation of the tension, short of a direct conflict, I can see how oil is going to be between $70 and $80 per barrel. And of course, if there was a direct military confrontation between US and Iran, oil could go well above 80, closer to 100. And of course, if there was a full-scale war between US and Iran, oil could be well above $100 per barrel. JP Morgan, using a basic model of demand for oil and supply, has suggested that if the Strait of Hormuz were to be blocked for, say, 6 months, that's an extreme case, oil price will go from 65 to 150, an increase of 125%. So getting to 100, let alone higher if there is a full-scale war, actually is the least that could happen. So those will be the implications for oil. Now, in my view, there are some flawed assumptions in the markets about what's going to happen in a conflict. And you hear often this argument that oil shocks today are unlikely as the world is much different from it was in the 1970s. As you remember, there was 1973 Yom Kippur War, spike in oil prices, 1979 Iranian Revolution, 1990 Iraqi invasion of Kuwait, spike in oil, and in each throughout the cases, you had global stagflation and recession. So the arguments are based on the following arguments. One, people say the energy input in consumption and production has fallen sharply relative to the 1970s. We don't depend on oil as much. Two, today, US is now energy self-sufficient given the shale gas and oil revolution. Three, inflation and inflation expectations today are much lower, and therefore central banks are not likely to hike interest rates following a stagflationary shock. And finally, people say the marginal propensity to spend of oil exporters, the Saudi and other today, is not much lower than the one of oil importers. So even if you redistribute income from importer to exporter, global demand is going to remain the same. Now, I believe that those arguments are invalid, and oil shocks are likely and matter even today for the following reason. First of all, even with lower energy use, large oil shocks reduce aggregate demand, and there are negative supply shocks. For example, even in 1990, when the oil use in energy in production was similar to today, the oil shock of the Iraqi invasion of Kuwait led to a global recession. So we're not like in the 70s, but oil is still important. Secondly, there are distributional effects within the United States. Of course, if oil prices spike, producers of shale gas and oil will have lots of revenue, lots of profits. They might eventually even start building more rigs, but usually it takes 6 to 12 months until they can increase production. So an oil shock in the Gulf for 6 to 12 months is a shock to supply. But then the users of oil, consumers, and other downstream firms that are using oil are going to be hurting. Think what would happen if oil prices go up 50% and gasoline prices go up by 50%, and utility prices for energy go up. US consumption is going to be squeezed because real disposable income is going to be squeezed. So distributionally, if you have a shock in oil, then the losers are going to spend less compared to how much the winners, that are the producers, are going to increase some capital spending. Third point is, even if the US is sheltered, this is a unified global oil market. WTI, this is the West Texas Intermediate, is going to go higher if Brent, the price in the Middle East, is higher. It might be a few dollars below, but if you have Brent at 100, WTI is going to be 90. The idea that there'll be a decoupling of US oil prices from the global one doesn't make any sense. It's an integrated market, even if you are self-sufficient. Additionally, as we know, key economies in the world are net oil importers. Europe, Japan, major emerging markets like China, India, Korea, Turkey, and South Africa. Of course, we are in Oslo. This is a country that has massive steel production of oil, but at peak, but that's an exception in Europe. Pretty much everybody else is a net energy importer. Two more points. If you have an oil shock, it's true that central banks are not going to hike because inflation and inflation expectations are low, so we're not going to have the hikes in the 70s. But it's also true that we know central banks don't have much room left. The ECB is minus 50. What they can do? Minus 60? Yes. Minus 70? Not much more. I was just in Japan. They can go from minus 10 to minus 20. Even the Fed has very little headroom, so the room for easing is limited. And final point is, if you have an oil shock, energy exporters are going to save some of that windfall because it might be temporary and there'll be war and other risk. They're not going to spend it, while those that are hit by the oil shock are going to cut spending, so global demand is going to be lower, global growth is going to be lower. So the idea they were very different from the 70s is incorrect. We are not as severely hit by oil as in the 70s, but a major oil shock will be still severe. Now, what's the impact of oil shocks in a basic demand and supply model? Here I'm using the model of JP Morgan. This is the most up-to-date that considers the fact that the energy input in production consumption today is much lower than 40 years ago. JP Morgan estimates in a recent piece that shutting down the Strait of Hormuz for 6 months spiked oil prices by 126%, dollar up to $150 per barrel. But even a 1 month shutting down of the strait leads to a rise in oil prices of $15 per barrel, from 65 to 80. And by the way, the model doesn't include two important things. One is precautionary stockpiling. When oil prices start to spike, everybody wants to stockpile oil, and price goes higher. And two, a fear premium. If you have a mess in the Middle East, the fear premium alone, regardless of demand supply, can spike oil prices. Those are not in the model. That model also doesn't impact important macroeconomic impact. If you have oil at 80, let alone 90, you have a risk-off episode. US and global equities go down, you have a tightening of financial condition, and that weakens economic growth. You don't have the option value of waiting. Last year, the option value of waiting was less capex because there were worries about US-China and a hard Brexit. Those two risks are now on the side in a limited way, but suppose there is a risk of an escalation of a war in the Middle East. Do you think that corporates are going to do massive capex? No. They're going to wait and see like they did last year, and that can push down business sentiment and capital spending. And for the consumer, in addition to the direct hit to labor income coming from higher oil prices, reducing consumption, you can have a hit to consumer confidence and precautionary savings. You don't know whether things will escalate. Better to be safe rather than sorry, save more. That further weakens the economy. So there are all these other channels of transmission to the real economy that are important. So my point is that there is a matching between the 4 scenarios for growth: expansion, slowdown, further slowdown, growth, recession, and global recession, and the 4 scenarios for the conflict: status quo, escalation, direct military exchange, full-scale war, and the scenarios for oil. Each one of them implies that with each one of these political scenarios, oil will be higher, global economy is going to be weaker. Now, of course, if there is going to be these types of scenarios, there's going to be also a policy response. Only in the best scenario, the one in which everything is fine, Fed, ECB, BOJ, and other major central banks are on hold today. They're going to stay on hold today, and you'll have the current set of fiscal policy. But if you have an escalation of the conflict, even a mild one, then the Fed would cut rates twice this year, in May and beyond, to 1%. The ECB is going to go to minus 60, and the BOJ to minus 20, and you'll have slightly higher fiscal stimulus in the Eurozone and Japan, but none in the US because you have electoral year, and there's a gridlock between Democrats and Republicans. Of course, if you have a direct military exchange that leads to oil above 80, short of a full-scale war, then the Fed would cut rates well below 1%. The ECB is going to go to minus 70, will do enhanced forward guidance, more QE on private and public assets. The BOJ might go to minus 30, could buy more ETF and other private and public assets. And you'll have a stimulus not only in Europe and Japan and other minor G10 countries, including Norway, but also some fiscal stimulus in the US because you'll have a beginning of a growth recession. Growth in the US will fall towards 1. People are going to panic. We're entering a recession. Finally, of course, if you're going to have a full-scale war, and then you'll have a global recession, the Fed goes to 0. It does forward guidance, quantitative easing. Other G10 will do variants of monetizing fiscal deficits, and you're going to get a large fiscal stimulus in all of the G10, more so in the countries that have greater fiscal space. I will conclude with some of the implications for asset markets. I'm not an expert. You're going to hear about other people about various types of scenarios, But I think that these 4 different scenarios have different implications for all the key asset prices. As I pointed out, scenario 1 of an expansion and the tension between US and Iran remaining mild is the consensus and the view of financial market. In that one, you have modest risk on throughout the year, and you have reflation of the economy and asset prices. US and global equities have single-digit returns. Why single digits? Because especially in the US, returns were so high, Ps are so high, valuations so stretched, that you'll be lucky if you get between 5 to 10%. Long rates in US, Germany, and Japan go modestly higher, maybe 20 basis points. Credit spreads remain low for high yield and high grade, and dollar and other safe and haven currencies weaken modestly because you're in risk on, and emerging markets and other currencies are going to strengthen compared to the safe haven. In the second scenario, where global growth is still at 3, but you have a correction of 10% of US and global equity markets because oil is at 80, then what you're going to see, you have long rates retesting the lows that you saw this past year when, say, US 10-year bonds were at 1.4. Credit spreads modestly widen, especially for high yield. Safe haven currencies like dollar, Swiss franc, or the Japanese yen appreciate, and gold goes about 5% higher. Now, suppose you have a direct military confrontation between US and Iran short of a full-scale war, and suppose oil is between 80 and 100. In that scenario, in my view, the correction turns into a bear market, and you have 20% down on global equities. Long rates go well below the 2019 lows. Credit spreads widen sharply, especially for high grade, because these are highly indebted firms. Some of them start to go bankrupt. And of course, safe haven currency appreciate by more than 5%, and gold goes higher, much more, 10% or so. Now, in the fourth scenario, in which you have a full-scale war, and you have oil at 100 to 150, and you get a global recession, you could have a 30 to 40% plus fall in US and global equities. US long rates go well below 1%, closer to 0. Bond yields and JGB bond yields go even more negative than the 2019 lows. However, spreads widen sharply for Italy and other risky developed markets, sovereigns and bond markets where you have lots of debt. So there'll be a separation between the safe ones and the other ones. You have a massive widening in spreads for high yield, high grade, and emerging market spreads because you have a global recession and many firms and some sovereigns are going to go bust. Gold prices spike highly, and of course you have a much sharply higher value of safe and haven currencies like dollar, yen, and the Swiss francs. So there is a clear matching, of course, between the 4 growth scenarios, the tension between US and Iran, what's going to happen, oil prices, what will be the macroeconomic policies, and what's going to be the market response. As I pointed out, of the 4 scenarios, my baseline was that even before the current shocks, return to global expansion was less likely than continuation of the slowdown for the reason I gave you. Given the shocks between and the tension build up between US and Iran, even in a scenario of 2, where you have escalation short of a direct military exchange, you end up in a weakening of global growth, and that weakening could be more severe if there is a direct exchange, and therefore this is a year in which, if everything goes right, you might have an upside for a variety of risky assets, but 3 out of those 4 scenarios suggest that things could be slightly worse. One important caveat, suppose that scenario 2 occurs and oil is at 80, but we don't have a full escalation. Some people say when ECB, Fed, and other central banks are going to cut rates, and in the past that easing has supported market. While in my baseline here, in the second scenario, stock prices fall by 10%, a correction. I think this time is going to be different, because if you have tensions in the Middle East, if oil goes to 280, and if there is a risk of episode, and initially there a correction, the Fed cutting rates 25 or 50 basis points, or ECB and BOJ doing only 10 basis points is not going to make a much difference. You'll have a year in which the tensions keep on building up until the US election, and therefore the market relief that you've seen in previous episodes, when there is a correction, then the central banks come to the rescue of economy and markets revert and go higher, is not going to occur. So in that second scenario, even if you end up with growth only at 3%, my worry is that the correction stays as opposed to being reversed in spite of the easing by central bank. But some people might have a different view on that particular subject. Okay, maybe I'll stop on this one, and I'll be happy to take any question you might have. Thank you very much for your attention.
Thank you so much, Professor Roubini. If everything goes all right, you said at the end here, I can't quite remember which year everything went all right, but what I would like to start to ask you is, given that you're right, that scenario 2 is the most likely, and all the different scenarios that you painted for us will happen, where should we be invested in 2020, given all the your predictions?
Well, first of all, I'm not an investor professional, and there are people who are doing professionally. Some of them are going to be speaking here. And of course, whenever there is scenario analysis, you have to impose probabilities. I gave you my probabilities, but markets have a different probability. They believe that, for example, the first scenario is more likely. That's the way it's priced by the market. Right now, I try to make the argument why that scenario is lower probability than even a mild escalation. And a massive escalation, you have a correction in US and global equities. But of course, you know, right now, the markets for the last 2 weeks have been right. There was a fall in US equity and global equity, and now people say, you see, they launched the rockets, they didn't want to kill any American, then the US restrained, there'll be negotiation, and everything's going to be fine. And maybe I'm going to be wrong. I try to make you the argument of why it's delusional to believe that Iran is done, is not going to escalate, but I might be proven wrong. You never know, there might be a negotiation, in which case the first scenario materializes. What are the consequences? I say any intelligent investor would say, even if I'm risk on, then things that are bad can happen, and then you want to hedge that, and there are a whole bunch of ways you can hedge even a risk on and being long into risky stuff with a bunch of instruments that allow you to essentially hedge that position in case things go wrong. That's one way of doing it. Another way might be to be slightly underweight into risky assets and having a little more of cash ready for stuff. If you are really sophisticated, you can short certain things rather than taking insurance. But the point is that believing that things will be fine this year, it's only the best of all scenarios. Under all other circumstances, taking some degree of protection. How much depends on your views, depends on your risk aversion and things of that sort, but it's wise to think that stuff could happen, and therefore you have to be protected for those downside scenarios.
Great. You also said that a Cold War is inevitable, even though we have the signing of the agreement, the Phase 1 agreement today. How, in your view, will a Cold War play out, or even escalate?
Well, a Cold War, there is the geopolitical part of it, and the tensions with Hong Kong, with Taiwan, East China Sea, South China Sea, and other stuff. I don't want to elaborate on that one, but I think both are about the economic and financial aspects of a Cold War. It means that essentially the current trade friction remain, and the rollback of tariff has been very tiny, not much. But more importantly, there is decoupling of the US fully on technology. The US wants to stop 5G of Huawei, and even the Chinese, after what happened with the ZTE case, and now Huawei, they know that the US can impose not only financial sanction, and financial sanction you can survive. You pay $1 billion fine. But suppose somebody says, you cannot use my technology, my software, my semiconductor, that can destroy not just ZTE, but Huawei is the biggest telecom country firm in the world. So the Chinese, even if there is a deal on trade, they know the US is going to pull the plug on 5G of Huawei after the US election, and they have an accelerated plan to become fully self-sufficient in the next 3 to 5 years in semiconductor, meaning either you produce them at home or you buy them from reliable suppliers in Korea, maybe Taiwan. But that decoupling in technology is going to occur, it's going to accelerate, and it's going to be full. Let alone the fact that now FDI by China is down 90%. They cannot buy anything but real estate. Even non-tech manufacturing firms are forbidden. It's taboo. And of course, in data and information, total also decoupling. I'll give you one example. There was a Chinese firm, a media company, bought a bunch of apps in the US, and one of them is a dating application for gay people. Now the US wants the Chinese to divest from this app Grindr, because they said the Chinese could have access to the data and who these gay people are. Some of them are in the closet, they could blackmail them. So even a dating app for gay people becomes taboo because there's a war on data. So this is the beginning of decoupling in data. All the data is to be storage. Even TikTok, people said US is going to say China has to divest of it because you'll have information about all the kids and teenagers that are playing with and so on. This is the beginning of decoupling in technology, in information, in data, of course in FDI, in investment, and on the monetary side of it, the currency deal is nothing. The Chinese, of course, can stay with revealing the reserves or having the RMB stable at 7. But you have potentially a country like China where cash has disappeared, like in Sweden, going to a central bank digital currency. You have Alipay, in which WeChat is used by billions of people in China. It's going to be internationalized, first for Chinese tourists and then for others. And then you could offer the model of digital payment system like Alipay and WeChat Pay to many emerging markets and frontier economy. So China's going to go and say, I'm not giving you just BRI and infrastructure. I give you e-commerce platform. I give you a digital currency. I give you payment system. And I give you also a surveillance system like we have it in China with the Great Wall and the social credit rating system. And 2/3 of the world, unfortunately, is not like Oslo, liberal democracy, US and Europe. It's semi-authoritarian, and plenty of people are going to say, I like that model. I like that system. I like those payments. I like that e-commerce. I like that Great Firewall. And they're going to use Chinese technology and goods. So we could have a world that is divided when, unfortunately, then the US is going to say, either my 5G or the Chinese 5G, my AI or their AI, my robotic or theirs, and then people in the middle will have to pick and choose, do I go with China or do I go with the United States? And unfortunately, by the way, most of the US allies in Europe, in Asia, in the Middle East, and even in Latin America, today they do more trade, more investment, more FDI with China than they do with the United States, while being geopolitical allies of the United States. But China is going to be putting pressure on those allies. Even the UK, strong ally of the US, they may allow some 5G non-core to be used by Huawei for the UK. Same thing in Germany. So the world is going to be asked by US and China, be with me or be against me, and it'll be very hard because it will be a world of deglobalization and decoupling. That's the risk we're facing today.
Are there any questions from the audience? Any hands in the air? Nope? Yeah, there's one there.
I think that's a really interesting scenario that you just laid on the table, but what I would like to know is where do you see Japan in that scenario?
Yeah, the question, I'm sorry, I'm just going to repeat that for the people who didn't hear you. The question is, where is Japan in this picture?
Well, I was just in Tokyo for a few days, and the answer is, what's the outlook for Japan in the short term, and what's the outlook medium, long term, including geopolitics. In the short term, the economy is still weak, but growing. Monetary policy is extremely easy. They could do a little bit more, but they're not going to do much more. There'll be another fiscal stimulus, be 0.5% of GDP, boosting the economy. Of course, they have to do structural reform to increase potential growth, but that's happening too slowly. People who have been betting there'll be a financial crisis in Japan have turned out to be wrong because most of the debt, even if it's high, is monetized by the BOJ. They keep on monetizing it, and it's mostly domestic, and there is moral suasion on the banks and capital controls that effectively can avoid a sudden stop. And therefore, things are going to be okay for Japan, not exceptional. Medium, long term, Japan has a declining population, but they use technology like robots to increase productivity, so that's their solution to the aging problem. They're not going to have technological employment. They're not going to have the problems of many migrants that rightly or wrongly are considered as being a threat. So it's a much more stable society. But you have the rise of China. Japan is an ally of the United States, but the US is becoming wobbly even with allies in Asia, telling them you have to pay more or this and that, and they cannot trust it. So even Japan is starting to edge and to pivot. Korea is doing it even more so because they cannot trust the United States. But if the US were to disengage from Asia, you could see how Japan is going to get closer over time to even a Chinese orbit. And the fact that the US gave up on TPP and Japan and other members of ASEAN have continued is a process of integration within Asia. So I would say things are okay. They're not exceptional. This will be an okay year for Japan.
Okay, great. We are heading to a coffee break, but first we need to give you a warm thank you.
Thank you for your attention. Thank you.